Diversification. When does it start costing you? Dear Owen and Kate, thank you for the great podcast. I was wondering if you had an opinion about the following question. When does your diversification strategy cost you more than it reduces your risk?
And this led me down another rabbit hole of the term diversification, where you diversify to the point and add so many investments to your portfolio because you keep trying to diversify that you end up reducing your returns because you're spending more on brokerage, you're potentially overlapping holdings and weighting your portfolio in a way that you don't want it to be weighted. So you may buy multiple, like you might buy VDHG, which is a diversified ETF where you have Australian and US and other types of holdings, but you also might invest in a 200. And without realizing it, suddenly you're overweighting your portfolio to Australia. And that might be what you want to do. You might want to do that on purpose, but you might not realize and you just think, I want to buy lots of different ETFs because if I have 20 ETFs, therefore I'm diversified. But most cases, when you buy 20 ETFs, you are overlapping holdings and you probably will end up building a portfolio that doesn't really match what you had in your mind.
Yeah. So, we've got ETFs now allow people to diversify really quickly. The basic idea of diversification is that we want things to move in different ways, or at least not all be exposed to the same risk. Imagine you buy 5 investment properties, they're all on the same street. That street is a flood-prone area, and it floods. That's all of your risk, like all your properties getting smashed. Whereas if you had them just on different streets or in different suburbs or different parts of the country, they wouldn't all be associated with the same one event. And that's the basic principle of investing. There used to be the rule called the rule of 30 or the race to 30, which was you own 30 different stocks, you diversified. Now, then there's academic studies that show beyond 10 positions, like beyond 10 different investments, the diversification benefit starts to rapidly diminish. So I think you get about 70% of the diversification benefit at 10 holdings or something like that. And by the time you get to 20 or 30, it's basically, there's no benefit.
And a lot of these studies are about individual share investing. So when it comes to ETF investing, if you've got 30 different ETFs, I would probably say you're over-diversified at that point.
Way too many. It's too complicated.
And you're creating like a headache for yourself at tax time. It's a lot more admin. You're getting more paperwork. You're getting more dividends, distributions coming through. So, I mean, in our core portfolio, the middle bit that we use for maybe 80-90% of our portfolio that has our exposure to Australian and US, I mean, I probably wouldn't have more than 10. I think I have 7 maybe.
Yeah, I mean, 5 to 10 is enough.
Yeah.
You probably, some people maybe even argue that you need 2 or 3 in there, like a diversified ETF, maybe a listed investment company, and I don't know what else you'd put in there. But you can, like our ETF portfolios inside Rask ETFs are only around about 5. And you can add optional extras in if you want to, but they're super simple. And that's really all you need for the core of a portfolio. I would advocate to every listener to have basically 2 different brokerage accounts. I'd have one set up that's optimized for ETFs in the core of your portfolio. And that might be ETFs. It could be, you might put listed investment companies or just whatever long-term, really core holdings go in there. And then have another brokerage account, which is your satellite portfolio. That's probably where you spend most of your time.
Yeah, that's where you get to scratch the itch, invest in a thematic ETF. But say you got a particular view on healthcare companies. Maybe you buy a healthcare thematic ETF in there, or you go, this is the stock that is going to be the next Afterpay. You have found it. Yeah. You would do that in a separate portfolio, so it doesn't. What happens in your satellite portfolio doesn't alter your long-term ETF core portfolio. And I think I'm more and more becoming an advocate of keeping your satellite and your core in 2 different brokerage accounts and not having the core portfolio on your phone, not looking at it every day, because knowing the price of one of your ETFs is $1 higher or $1 lower than it was yesterday does not really help you, especially if you've got a long-term time horizon. And also you might automate them in different ways. So with my satellite portfolio, I won't automate any of that because these are usually manual decisions after I've researched or looked through things or written down why I'm going to buy that company.
Yep.
Yeah, well, if I do, I'll let you know on. But my core portfolio, I've automated that because it's not something I need to change my decision on a regular basis. Maybe I check in once a year to see if I want to rebalance or change my strategy, but in the long term, it's not something that needs to be looked at daily. So I think there can be a danger if you're looking at ETFs and your satellite shares and thematics in the same portfolio.
Definitely.
They're serving a different role.
Yeah. You can think that, I need to do this, I need to move now. Yeah, it doesn't really work that way. So I just say, for most investors, five ETFs is probably enough. Maybe 10 if you probably don't need 10, to be honest. 5 is probably enough for the core of a portfolio.
Yeah.
Maybe
Some people have
more here or
different
there.
views on having like small caps and emerging markets and infrastructure in their portfolio.
Yeah, and they
or like
want those
Australian
things.
and global bonds. So it does depend. Most of the portfolios, the core portfolios I see that are diversified, if you look at super funds or you look at portfolio builders that you can Google online, I'll put them in the show notes, but BetaShares, BlackRock, Vanguard, and robo-advisors will often publish their example using their own products usually of what a core portfolio could look like, but usually they're 5 to 10. I've not seen any that have more than 10.
Yeah. Just be careful with those tools because a lot of them will talk about different ETFs that make them very good fees. So if you go to a barber and ask for a haircut, they're going to, do I need a haircut? Of course, they're going to say yes. And that's kind of the outcome here. But
I think it's a good starting point though. If you're like, I don't know what a high growth portfolio looks like, look at 10 different high growth portfolios and see how they make them up. They might be shoving in an ETF that doesn't really form part of a high growth portfolio, but they're just putting it in there because that's their only product that they can fit in. Mm-hmm. So that's why sometimes I like looking at advisor portfolios. Even you can have a look at like Raise Invest. They actually put the breakdown of the ETFs. I'm pretty sure they name them as well for what their high growth portfolio looks like. So I'll put all these examples in the show notes. I think they're a great education tool. If you're at the very beginning and going, what does a high growth portfolio actually look like? You can use as many sources as you can to start figuring out what that looks like. And then if you go, okay, as part of my high growth portfolio, I want to be invested in the top Australian companies. Then you can go on that journey to compare ASX 200 or maybe 300 ETFs and see which one might be the most suitable for your high growth portfolio.
Yeah, that's perfect. And from there, you can work backwards. So you can say, okay, well, if you're starting with $10,000 today, how much would I need to put in each one? It's actually, pretty straightforward once you get the hang of it. And then you can say, if I've got 10,000, I'm going to keep 1,000 for my satellite portfolio, and I'm going to be a bit more, risky out there. But that's a really simple way to think about it. We do have a lot of our members that write in, and they are share investors from decades, and they have big positions in those shares because they've done well and they can't sell them. That's a different scenario. If you've inherited a portfolio or you've got a portfolio of shares that have been built up over the years, that's different. But you would still try and have some balance between what's diversified, what's not. So you would look at your entire portfolio and say, okay, this is my satellite, that's in my core. In my core, am I still, do I still have, 80% in shares, Australia and global, and then 20% in bonds or cash or something like that?
I think the big message is that no one's portfolio looks the same, maybe unless they're using the same robo-advisor, but everyone's going to have a different amount invested, have different goals. And I think it's important not to race to the perfect portfolio because there is no one perfect portfolio. So you're just finding something that is pretty good for you because you can get obsessed with finding the perfect portfolio and it can cause you a lot of tax implications and cost you brokerage because you keep switching between things trying to find a better option. So I think you want to find something that suits your needs and is like pretty much there, but doesn't have to be perfect.